Hi, I'm Mike Resnick, an associate in the tax department at Sutherland, and I'm joined today by a partner in the department, Ellen McElroy. We look forward to discussing with you the new tangible property regulations.
In the decades leading up to the release of the tangible property regulations, there was significant controversy that arose regarding whether costs attributable to tangible property could be deducted, say as repair expenses, or whether those costs had to be capitalized. And if you think about tangible property as encompassing buildings, machinery, and equipment, you can imagine that this controversy was frequent. More importantly, the decades of case law was also very fact-specific because there are a myriad of situations that may arise in that broad base of property, but also very results-oriented. And so it was hard to glean conforming principles. What the government has done with these new regulations, which are effective for the 2014 tax year, is that they've reduced the subjective determinations and they've added a number of simplifying conventions. So it's really important to recognize that these regulations are effective in this year. What that means as a practical matter is that companies across America have to think about whether to file accounting method changes to comply with these new rules.
One of the first group of expenses that the regulations address are acquisition costs. And historically, taxpayers have had to capitalize costs, including transaction costs, to acquire or produce tangible property. What these regulations did was provide a single source of rules to govern taxpayers' treatment of such costs.
The rules also describe the circumstances in which transaction costs are capitalized because they are different with respect to real property versus personal property. The single most important exception to these rules is the one for de minimis purchases. Prior to the implementation of these regulations, many companies had questions about when de minimis costs could be capitalized. And it was especially frustrating because they were deducted for book purposes and companies wanted to deduct them for tax purposes. These rules specify a de minimis exception both for taxpayers with applicable financial statements, which are generally audited financial statements, and those without.
What these regulations also provided was needed guidance on the treatment of materials, supplies, and rotables, which guides us neatly into the discussion between repairs and improvements.
As I mentioned, an area of controversy was whether expenses are deductible as repair expenses or whether they have to be capitalized as improvements. What these regulations do is provide clarifying standards to determine when an amount is considered an improvement to property. It looks specifically at whether the activities result in a betterment, a restoration, or adapt property to a new or different use. In those circumstances, the costs look to be improvement and are not deductible. Nonetheless, there are significant opportunities to deduct repair expenses, and so it's important to take a long, hard look at the repair expenses in any company to evaluate what might be deductible. These rules also provide a routine maintenance safe harbor, which is very helpful for ongoing maintenance to tangible property, and it also allows companies to elect to capitalize repair costs, which can simplify compliance by allowing them to follow, for tax purposes, what they may be doing for book purposes. The election is available on an annual basis, so a company can decide year to year what to do and how to handle it.
In addition to identifying the difference between repairs and improvements and discussing acquisition costs, the regulations also addressed dispositions, namely revoking the general asset account election. The regulations also provided for a late partial disposition election, which is important for taxpayers to consider if making a disposition in any taxable year. It is also important to note that only treated as method changes will dispositions be for tax years beginning before January 1st, 2015.
Mike, we have gone through this at a really accelerated pace. You and I could have talk about this for days because there's so many issues that arise under the tangible property regulations. But hopefully this short overview will be helpful as companies are thinking about how to comply with the rules in 2014.
If you have any questions, please feel free to contact either of us and see Sutherland.com for more bottom line videos.